Welcome to Fundamentals, where I'm going to look at one of the most popular tracker funds on the AJ Bell Youinvest platform right now, namely Vanguard FTSE 100 ETF. Now, an ETF, or exchange traded fund, it's a tracker. It's designed to track the performance of the underlying assets and deliver that performance minus its running costs. Now, this particular tracker is therefore following the broadest and best known indices of all, our very own FTSE 100. Now, Vanguard FTSE 100 uses physical or direct replication to generate performance, so it owns the underlying securities, which in this case are the UK's largest quoted firms by stock market value. Royal Dutch Shell, HSBC, BP, British American Tobacco and GlaxoSmithKline, they're the 5 biggest holdings, and between them they represent 31% of the portfolio. By sector, financials, oil and gas and consumer goods are the biggest weightings, with technology coming in with a pretty minimal presence, and that via software firms Sage and Micro Focus. This tracker, well, it's a big one, with assets under management of around £2.3 billion. This size, plus the identity of the index it's tracking and the constituent stocks, should mean it's pretty liquid and easy to trade, at least under normal market conditions. The tracker comes with an annual total expense ratio of just 0.09%, so it's pretty cheap, and it also comes with a 3.8% dividend yield, and the dividends are paid quarterly. For those who care about such things, Vanguard FTSE 100 ETF comes with a 3-star Morningstar rating, and, as a final point, it's one of the 16 trackers which make up the top trackers list provided by our investment guidance service. However, it doesn't feature in the cautious, balanced or adventurous portfolios, and it's there as an alternative to the FTSE All Share tracker, which represents 13% of cautious, 25% of balanced and 40% of adventurous. So, those are the mechanics. The question is, why would your fellow investors be potentially buying Vanguard FTSE 100 ETF right now? And I think, well, there are 3 possible reasons. First, the FTSE 100 index, well, it's busily setting a string of new record highs, and those sorts of headlines always get plenty of attention. The pretty simple trend of pound down, owing to Brexit worries, dollar up, owing to hopes that President Trump's tax reform, deregulation and infrastructure spending plans will get the US economy going, well, they're helping to drive the FTSE 100 higher because 2/3 of the index's profits come from overseas. The lower the pound goes, the higher those overseas earnings are worth, the more they're worth. It's like going into a sweet shop and finding all the bags are 15% bigger for the same price. Second, if you really believe in the Trump trade, the UK is a good way of playing it. As we can see here, half of the index's forecast profits for 2017 are due to come from banks, insurers, miners and oils, all sectors that could benefit from a more buoyant US and global economy, or the increase in bond yields and maybe interest rates, which would follow better growth. The same quartet also generates half of the forecast dividends for 2017 and half of the forecast dividend growth, while the same foursome, banks, insurers, miners and oils, are expected to provide 3/4 of profit growth for this year, as we can see in the next graphic. So if you think bond yields, oil prices and metal prices will keep rising, then the FTSE 100 has the potential to be a good place to be, but that will all depend on whether you agree with that or not, and that's something only you can know. Now, the third and final reason may be that the tracker is actually cheap, the third reason for its popularity, with that annual ongoing charge figure of just 0.09%. That beats most of its fellow trackers and comes in way below the average actively managed funds, where fees may still run from 0.5% to 1% a year. Now, there are risks, not least that the Trump trade could disappoint and economic growth around the world remain flaccid. We also still don't know what Brexit may or may not mean for the UK, and if the pound were to unexpectedly rally for any reason, well, that could put a spanner in the works as well. As a final point, do remember that stock markets, when they work well and when they're used properly, are a get-rich-slow scheme, not a fruit machine where you go looking for jackpots. The real secret is the patient harvesting and reinvestment of dividends. Since the 1999 peak, the FTSE 100's up 5%, and that after some pretty big ups and downs as shown by the final chart. But if you include dividend reinvestment, it's up 89% over the same 17-year period. So, as with any investment, before you put any cash to work, you must therefore ensure that Vanguard FTSE 100 ETF fits with your overall strategy, target returns, time horizon, and tolerance for risk. Thank you for watching, and I look forward to seeing you next time.